Most people think you need a high-paying job, good credit, and a lot of money to buy a house. But that's not actually true. Real estate investors buy houses all the time using loans banks would never give normal people. And some of these investors started out broke, unemployed, with bad credit and almost no money. And the craziest part? This entire strategy is completely legal. So how does it actually work? In this video, I'll show you how it works step by step. Step 1. The first door into the system. The first thing broke people use to buy houses is something most people have never heard of. It's called hard money lending. Think of it like this. Instead of a bank looking at your job, salary, or credit score, a hard money lender only looks at one thing. Is the house itself worth the money? That's it. If the deal makes sense, they fund it. Hard money lenders are usually individuals or private companies that give short-term loans backed by real estate. In simple terms, the house is the safety net, not your job. So if anything goes wrong, they don't rely on you. They rely on the property. Now here's what makes this powerful. A hard money lender doesn't ask, "What's your credit score? Do you have a stable job? Can we trust your income history?" Instead, they ask questions like, "What is this house worth right now? Can it be sold for more after repairs? If everything fails, can we still recover our money from the house?" That's why this system is used by investors to buy houses banks refuse to touch. Because banks take weeks or months to approve loans, hard money lenders can fund deals in as fast as 24 hours to a week. Even people with bad credit, no traditional income, unstable financial history can still qualify, if the deal makes sense. But there's a catch. Because the risk is higher, the cost is also higher. Interest rates can range from 10% to 20% plus, and the loan is usually short-term, about 6 to 12 months, which means this is not a long-term loan. It's a fast entry tool, a way to quickly grab a property opportunity that others can't act on fast enough. Now let's say you secure a loan of $385,000. At a 17% interest rate, that means you owe about $442,750 total. So the real question becomes, how do investors use a short-term loan like this to buy a house and still come out profitable? That's where step 2 begins. Step 2. The part that doesn't make sense at first. Let's break this down in the simplest way possible. As an investor, you use the hard money loan to do 3 things. Buy the house, fix it up, and prepare it for rent. So imagine this. The house is bought, repaired, and ready to rent. Now it starts generating about $3,000 per month in rent. First, it looks like everything is working. After expenses like bills and maintenance, there's about $2,200 left. And you use about $2,000 of that to start paying the loan while you keep $200 as your income. So, on paper it looks like income is coming in, loan is being paid, deal is working. But here is the problem. This is where most people get stuck. If you try to pay back a $442,750 short-term loan using $2,000 per month, it would take over 18 years to finish paying it. But remember, hard money loans are not 18-year loans. They are usually only 6 to 12 months long. So now we have a contradiction. The deal looks profitable, but the repayment timeline doesn't work, which means this strategy should fail. But it doesn't. So the real question becomes, how do investors escape a loan that has to be paid back quickly, using income that is too slow? And that's where the entire system changes. Because they don't rely on rent to solve this problem. They use something completely different. That's step 3. Step 3. Here's the hidden solution. Now here's where everything changes. The problem in step 2 was, the rent is not enough to pay off the short-term loan fast enough. So investors don't rely on rent to finish the payment. They use something called DSCR refinancing. Let me explain it in the simplest way. DSCR refinancing just means replacing your current 6 to 12 months loan with a new loan of 15 to 30 years. The lender only asks one question. Does this house make enough rent to pay its loan? Let me give you an example. If the house generates $3,000 in rent monthly, and the monthly loan payment is $2,000, the loan will be granted. Because the house is paying for itself. That means from the $1,000 remaining you can pay in utility bills of the house, and keep what is left as your monthly income. Now here's the key move. Once the house is repaired and rented out, its value usually goes up. For example, You buy and fix the house for $385,000, and now it is worth about $700,000. So the bank can now issue a new loan based on the improved value. Let's say they give $650,000 new loan. You then use part of it to pay off the original $442,750 loan. And here is the part that changes everything. You didn't just solve the problem. You also unlock extra cash. That extra money can be used to buy another house and repeat the same process again. This cycle is called BRRRR, meaning buy, rehab, rent, refinance, repeat. And that is how some investors with no money quietly scale from one property into multiple rental houses over time. So what you've just seen is not a get-rich-quick trick. It is a system, a way real estate investors used to get into properties with almost no money up front, use short-term loans to acquire assets, and then convert them into long-term self-paying investments. But here's what most people miss. This is only one strategy. There are other ways investors buy houses without using their own money at all. They structure deals with multiple layers of financing and scale from one property to many much faster than most people realize. If this was your first time hearing about how this system actually works, then you are only seeing the surface level. There are deeper strategies behind this that most beginners never learn. If you want me to break down the next level strategies that investors use to scale this even faster, let me know in the comments. And if you want more breakdowns like this where I explain how real systems actually work behind the scenes, then you might want to stick around for the next one by subscribing.